I'm Tennille.
And I'm Kelsey, and we're financial advisors from Allman Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. Welcome back to another Wealth Experience podcast, and we're joined again today by Mark Everingham from PRP, Personal Risk Professionals, talking all things insurance. So this is part 2 of 3. And today we wanted to deep dive a little bit more into the world of the premium volatility. And we did touch upon this in our last episode, which was a bit of a longer episode. So this is just to do a little bit more of a deep dive around what is driving those premium changes. So I think it's really important for Australians to understand, why is this happening? Why is, everything's becoming more expensive? Why insurance too?
Yep.
So we'll talk about that. And thank you again, Mark, for doing this podcast. So
my pleasure.
What is driving this? What is driving the premium changes and the increases that we're seeing?
Yeah, so there's 4 really distinct issues that are all happening at the same time that unfortunately have driven, premium volatility and significant structural change in how the insurers are pricing cover. The first one is claims experience, particularly in income protection and in TPD cover.
And by claims experience, Mark, you mean the people that are handling the claims, is that correct?
So I'm talking about the incidence of claims that the insurers are having to pay out.
Okay, yeah.
So it's the number of claims being paid, the amount of those claims, and the duration of those claims. So income protection and TPD cover have seen significant increases in mental health claims, particularly in the TPD space for 30 to 40-year-olds, claiming for inability to ever work again due to mental health.
Yeah, wow.
And it's up like 700%.
I think it tells you a lot about what's going on in society just by looking at those sorts of numbers.
Trying to the actuaries could not predict that sort of stuff was happening, so that it wasn't priced in, so that when the claims occur, the amount of the size of the claims are large. The income protection claims are going for a lot longer than expected, so those things all impact profitability for the insurer.
Yeah, because the actuaries are past looking, is that correct? They're looking at past numbers and then make some predictions about the future based on
it's
that?
Sort of like, what's the likelihood of an outcome based on the data we've got from the past and what trends are we seeing for the future? So, the mental health claim incidence is significant and it's very expensive. So there's really 3 levers to pull on managing that. Pricing's one. We increase the cost to cover off the increased risk and loss that we're suffering. We changed the product. So that's why there was income protection changes I mentioned in the last episode that occurred in 2021 to change the generosity of the policy. We're going to go through something similar with TPD shortly. So claims experience is the biggest driver of profitability. The second leg is the distribution market for the insurers. How easily can they distribute their products through the market? If you go back pre the Royal Commission, the biggest distributors of life insurance products were through the banks, through their financial planning arms. It was, do you want some insurance with that loan? It was almost as simple as that. You take a home loan out, you'll get some insurance to go with it. All the banks exited life insurance and financial planning for that matter post Royal Commission. And then you had all the education reforms come in where, advisors need to be degree equivalent qualified. So those 2 things led to a significant reduction in advisor numbers. We've gone from 30,000 10 years ago to 15,000, I think it is, sitting about now. So we've halved the advisor force, and that's how insurance is sold in Australia fundamentally for insurers. So they went from having new business inflows from an industry perspective of close to $1 billion a year down to 300 million. So that's a huge drop in revenue, which in turn would drive a loss of profit. So again, there's a lever they need to adjust to compensate for that. That just drives a profitability issue for the insurer. High claims, low inflows creates...
And ultimately, for the business to be sustainable, they have to be profitable, right? And that's how they continue to exist, and that's how you continue to have insurance that's available.
Absolutely. So the job of the insurer is to maintain sustainability and reserving of capital to pay future claimants.
Yeah.
So if they're not profitable and they can't reserve for those future events, then you'll have product failure.
Yeah.
So it's not an insurer trying to gouge a policyholder for premium. It is then creating a pool of sustainable resources so they're there for all the policyholders in the future.
Yeah.
Yeah, and the fourth thing that compounds that is we've just gone through a really low interest rate period environment at the same time. So what most people don't realise is collection of the premium is the insurer then investing that pool of money to create those reserves and returns to pay future claimants and run the business. The insurers are restricted on where they can invest their money. They have to be in secure yielding assets like fixed interest markets and those sorts of things. When you've got interest rates at the lowest they've been in for however long, their return on their investments are significantly lower. So you've got
everything's sort of doubled down on top of each other.
You've got four factors that are all occurring at the same time in the wrong direction. That are unfortunately driving insurers to go, well, we need to be there for our policyholders. So the first lever we have to pull is a premium lever. Yeah,
that's really interesting. I wonder if you know any stats on whether there was a difference to shareholder return for a period of time. Whether, did that take a hit for a period of time?
I imagine there certainly would be. There's a couple of insurers that are, they're listed companies. So, Clearview is an example. You can go and look at their books, and it's a publicly listed company, so that the information's there. Yeah, interestingly, there are different models of insurers. So PPS Mutual is an example where they're the only mutual insurer. So they're not a shareholder-owned company like every other insurer. So their pricing volatility has been very different to the rest of the market because they're able to take a longer-term view on things, if that makes sense. Yeah. So there is certainly difference in the structural models of the insurers.
Yeah, and not every insurance policy is made the same, and we've spoke about this a little bit in the previous episode, but you sort of mentioned that there was certainly an increase in people in their 30s and 40s claims, TPD claims, or mental health claims, whatever that may be. Are there policies out there that will actually reward you for being healthy and living a certain lifestyle, or is there anything that you can do as a policyholder that's going to drive that policy down?
Yeah, most of the insurers will have some form of healthy life discount. So if your BMI is below a certain level, you'll get a discount. There's other insurers that have health and wellness programs that if you participate in, you maintain or grow a discount in them. So
what would that involve, Mark?
So some of them are as simple as when you do the application, what's your height and weight, and that translates to, so there's not a lot involved. There's others like AIA's Vitality Program where they're really trying to drive behavioural change, and so they're sort of tracking you having health checkups, going to the gym, all that sort of behavioural sort of stuff.
So as the policy owner, you have to report back on that to them every so often.
Yeah, effectively you do. So I think it really depends on the type of person you are and the lifestyle you already lead. Like, I, to be honest, haven't seen a lot of success of people fundamentally changing their way of living to get a discount on an insurance policy. Yeah. But if you're someone who does go to the gym regularly, does a lot of health checkups and all that sort of stuff, then you can get rewarded for the lifestyle that you live by doing something you're already doing. Yeah. So the insurer is obviously wanting you to encourage you to live a healthier life because you're a better risk to them, and it's a better outcome it's a win for everyone.
Absolutely. Yeah. No, it's good to know that stiort of thing, is out there for people that maybe go, well, I am looking after myself and I am healthy. I still want insurance, but how can I get it at a more affordable price perhaps? So that's a really good one. So thinking about pricing again, is there, ever situations where reducing your cover is a sensible strategy? And obviously we've got the obvious one. Well, your situation has changed financially, so
yes. I think there's two really important factors to this strategy. So obviously cost and being able to afford cover. If you can't afford it, it's obviously going to be detrimental to your financial circumstances and something's going to have to give. So altering or reducing your cover certainly makes sense in those sort of circumstances, but you want to do it in an informed way. So, if you've got a portfolio of cover, what levers can you pull to impact those pricing changes, and what are the consequences of doing it? So, for example, if you have a 30-day waiting period on your income protection policy and you move that to 90 days, the premium is going to generally go down about 25%. So what's the consequence of doing it? Well, the insurer is not going to pay you a benefit until you're off longer than 90 days at work. So, do I have the ability to fund my life for that period of time? And if so, there's an informed decision to make.
Yeah. And for people that, is it possible, and I know I've been outside of the insurance world for a little while now, but if you perhaps have a pre-existing condition on the policy, is it sometimes worthwhile actually going back and reviewing that? Because, some insurers might say, well, we're not going to pay out a claim for this particular health event, but if you can, come back in, 5 years and show us that that's, gone, then you can have the loading removed off the premium, or you can be insured for that again. Is that still something that exists?
Absolutely. So a really good example of that would be sleep apnea, for example. So 5 years, 10 years ago, if you applied to an insurer with sleep apnea, there's every chance you just declined for cover across the board.
Wow, okay.
That then changed to loadings, of saying you're going to pay a high premium because of that.
Yep.
Now, if you have sleep apnea and you're on a CPAP machine and it's controlled and you can provide the evidence from the data on the machine that you're compliant, that's generally now standard rates.
Yeah, okay.
So
it's come a long way.
Changes in medical technology and treatment does drive change in the insurers for certain conditions. So it's the same if when you applied for cover, you had a recent health event which warranted an exclusion. Like if you had a strained shoulder or something in the 12 months leading up to applying for cover, and they said, well, because of the recency of this, we're going to exclude it, but you've since been symptom free for a couple of years, then it's definitely worth going back and saying, look, can we have a look at this exclusion? Yeah. Because this is no longer an issue, and that could get removed.
Yeah, absolutely. So if pricing is becoming an issue for you, it's one of those things where, don't just cancel it. If you don't ask, you don't get sort of situation. Just make sure that you're exploring all of your options, because you could have some good reductions in there that you might second guess whether you do cancel it or not.
Yeah,
so
especially if you've got loadings on your policy. Yeah, absolutely.
Yeah, so that's your first option, I guess.
Yeah.
And then the other one might be, okay, well, do I transfer to my super fund and trade off my future self income to fund the premiums for now is the other one.
Yeah.
But is there kind of any other situation where it is sensible to reduce your cover?
Yeah, I mean, the other alternative, like with the volatility of pricing that's gone on, if you've held that cover for quite a long time, pricing of a new contract compared to that old one could be much more favourable. So because of how the insurers are pricing new cover versus old cover, so looking at either being re-underwritten with that same insurer for their current product, or looking at an alternate insurer might be a way of saving premium without actually fundamentally undermining your insurance.
Yeah.
Or you could do both. Like if you're going, okay, well, we can save money by moving insurer, but also do a bit of self-insurance and those sorts of things, and there are ways of doing it.
Oh, you've got to be careful with that though, right? Because you can't just cancel a policy and get a new one without thinking about, well, what am I going to lose?
So what am I going to lose is certainly the big one. Your health circumstances at that point in time compared to before is the other part. So when you enter into an insurance contract, you've got a duty to not misrepresent to the insurer. So you need to make them aware of all your medical history, hobbies and pastimes at that point in time leading up to your application. So if you're 50 years old like me, and the last time you were underwritten was 20 years ago, I've got to remember 20 years worth of medical history on top of everything else. So,
and the potential to then not have a claim for all those medical issues on your new policy.
Absolutely. So you've got to take that quite seriously and make sure that you are providing the insurer the full picture. But even that strategy of reducing cover, your health circumstances really need to be considered at that point in time, because once you've reduced cover, if you want to get it back again, you're getting underwritten again. So if you've had a change of health circumstances, you're doing it knowing that if your health's changed, you might not get back what you want. We have had numerous occasions where clients are wanting to reduce cover, and before they do, we tell them to go get medicals done, because...
And that should be a standard process,
absolutely,
right? Every
it should
time
be.
you're thinking of reducing cover.
Your duty of care to your client should be make sure you're healthy enough to make this change.
Yeah.
before you make it. 18 months ago, we had a gentleman in that exact scenario. His business was had been struggling a bit. Premiums were getting pretty expensive. He said, look, can we look at reducing cover here? The most expensive type of cover out of all of them is trauma insurance because it's the most likely thing to claim on. Mm-hmm. So he said, look, can we probably cut this a fair bit or get rid of it? And I said, look, just go and get a full health check with your doctor before we go and change it. Mm-hmm. He went to his doctor. His PSA was through the roof. He had prostate cancer, didn't know it.
Wow.
And so...
Can you imagine as well, that would have reared its head at some point and he may have cancelled that cover.
Yeah. It would have reared its head at some point and it might have been at a stage where it was found too late and the consequence for him was a lot more than missing out on an insurance policy.
Yeah, absolutely. And that's what I was just about to say, that is, whether he had a claim or not, at least he was able to have that point of someone going, just go and get your health checked. Because, how often do we see people just neglect that?
Yeah, especially blokes.
Yeah, it's so common, until it's a real problem. Some people just go, I'll be okay. Yeah. But, something big is brewing underneath. So, I think even just that in itself is so powerful.
Yeah. And as I said, we've fortunately and unfortunately at the same time, we've had that outcome a few times. Obviously unfortunate because obviously the situation the clients are in, but fortunate from the point of view it got caught early and the policies are then able to respond when they needed to.
Yeah, absolutely. So I think, that's a really good overview, Mark, of, helping everybody understand, it's not about, the insurers, generating bigger profits and earning more money. There's a real reason that lives behind this. Yeah. The society that we're living in, the changes in legislation, different economic factors that have all come into play that have caused this increase. And, hopefully it just means that with these changes, insurance is a little bit more stable. We've got a little bit more stability in terms of, the products that are available, the prices, etc. So I think that's given us some really good insight there. So thank you again for your time.
Pleasure.
We do have you back for another podcast, which is we're going to be talking a little bit about estate planning and insurance. I think some people have this line in the sand where you only need insurance up until when you pass away, and then don't think of anything else beyond that. So I think there'll be some really good conversations within that. So listeners, make sure you tune back in and listen to Mark's very in-depth expertise in this space. Join us next time on the Wealth Experience podcast.
Want to invest your hard-earned money but don't know where to start? Allman Partners True Wealth presents AP Direct Invest, your online self-directed investment solution. Choose from 6 low-cost exchange-traded fund portfolios, including 2 socially responsible options. To manage your own investment experience, visit allman.com.au/AP Direct Invest and start your investment journey today. AP Direct Invest, your investment solution. Any financial product advice is general advice only and may not be appropriate for you. Always read the PDS.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.